Welcome to Department of Distance and Continuing Education, University of Delhi, Masters of Business Administration, Semester 1, Core Course MBA FT 6104, Accounting for Managers. Lesson 3, Depreciation. 3.1, Learning Objectives. After reading this lesson, readers will be able to understand concept of depreciation, objectives of providing depreciation, factors influencing depreciation, methods of depreciation, accounting entries for depreciation, how to treat change in cost and residual value or life of the asset, accounting treatment for change in method of depreciation, accounting treatment for revaluation of depreciable assets, accounting treatment for cessation of depreciation, accounting treatment for retirement, accounting treatment for sale or disposal of depreciable assets. 3.2 Introduction. The assets which are expected to give benefit over a long period of time are not charged to expense at the time of their acquisition, rather they are capitalized in the balance sheet as fixed assets or property, plant and equipment and are charged to profit and loss account through the medium of depreciation or amortization. As per Ind AS 16, property, plant and equipment are the tangible assets that are held for use in production or supply of goods or services or rental to others or for administrative purposes and are expected to be used for at least 12 months. Part of the acquisition cost of the fixed assets allocated as an expense in each of the accounting period in which the asset is utilized. The amount of fixed assets allocated in such manner to respective accounting period is called depreciation. 3.3 Meaning of depreciation. Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. It is the reduction in the value of fixed tangible assets due to wear tear, upgradation of technology and a flux of time. Depreciation commences from the day the asset is available for use even if it is not put to use. 3.4 Objectives for providing depreciation. Depreciation is charged on property, plant and equipment to serve the following objectives. Number 1. To calculate true cost of production of goods or services rendered which involve usage of fixed assets in their production. Number 2. To correctly measure the income as per the matching concept. Number 3. To depict true financial position by valuing the assets after deducting depreciation. To provide internal funds for replacement of fixed assets by charging depreciation from profit and loss. 3.5 Factors influencing depreciation. Calculation of depreciation is based on the following three factors. Number 1. Historical cost or other amount substituted for historical cost of the asset when revalued. Historical cost is the amount which is paid by the entity. Number 2. Estimated useful life. Number 3. Estimated residual value. These factors are explained as follows. Number 1. Historical cost can be calculated in the below tabular format. First we take purchase price, then we add other non-refundable taxes and duties, then we add any directly attributable cost of bringing the asset to its working condition for its intended use, then we less trade discount and rebates, if any, then we get the cost of asset. Second is useful life. Useful life is either the period over which a depreciable asset is expected to be used by the enterprise, or the number of production or similar units expected to be obtained from the use of the asset by the enterprise. Number 3, residual or scrap value is the amount likely to be obtained by the disposal of fixed asset at the end of its useful life. Depreciable amount. Depreciable amount of a depreciable asset is determined as under. We can calculate the depreciable amount as per the following table. First we take in the first column particulars, in the next column we take amount. So first we will take historical cost or other amount substituted for it in the financial statement less estimated residual value, then we get depreciable amount. 3.6 Methods of depreciation. The following methods are available for computing and allocating the depreciable amount of an asset over its useful life. Fixed installment or straight line method, reducing balance or written down value method, sum of digits of years method, machine hour method, production units method, depletion method. 3.7 Fixed installment or original cost or straight line method. Under this method, an equal or constant amount of depreciation is written off from depreciable asset every year. Suitable for assets which generates equal utility during every year of its useful life. At the end of the useful life of the asset, the cost of the asset will be nil or equal to its residual value or scrap value. Straight line depreciation is equal to cost of asset less residual value divided by useful life. Straight line method depreciation rate is equal to SLM depreciation into 100 divided by cost of asset. Example, X Limited purchased a machine costing rupees 10 lakhs having a useful life of 5 years. Its estimated residual value is rupees 1 lakh. Straight line depreciation is equal to 10 lakh minus 1 lakh divided by 5 equal to rupees 1,80,000 per annum. SLM depreciation rate is equal to 1,80,000 into 100 divided by 10 lakh is equal to 18% per annum. 3.8 Reducing or diminishing balance or written down value WDV method. Depreciation amount for each year is computed by applying a fixed percent on the opening balance of the asset, that is diminishing balance of the asset. Reducing balance refers to the written down value of the asset, that is value of the asset as reduced by the depreciation up to the previous year. The value of the asset will never be extinguished as it happens in SLM method. Depreciation rate is computed such that the end of the useful life of the asset, the cost of the asset will be equal to its residual value or scrap value. WDV depreciation rate is equal to 1 minus nth root of the residual value divided by cost of asset, where n is equal to useful life. For example, X Limited purchased a machine costing rupees 10 lakh with scrap value of rupees 2,50,000 and useful life of 10 years and has ascertained its written down value rate as 10% per annum, depreciation rate will be calculated as follows. WDV depreciation rate is equal to 1 minus 1 by 10th root of 2,50,000 divided by 10 lakh is equal to 12.95% per annum approximately. 3.9 Sum of digits of years method. It is a variation of the WDV method. Under this method, depreciation amount for each year is computed by applying the following formula. Depreciation is equal to depreciable amount into number of years of balanced useful life including current year divided by total of digits of useful life of the assets in years. Example, X Limited purchased a machine costing rupees 78 lakhs having a useful life of 5 years and estimated scrap value of rupees 3 lakhs. Depreciation amount for the first 5 years will be sum of digits of the year is equal to 1 plus 2 plus 3 plus 4 plus 5 equal to 15. Depreciable amount is equal to 78 lakh minus 3 lakh is equal to 75 lakh. So we can calculate through the following table. So depreciation amount for the year 1, 2, 3, 4, 5, 70 for the first year 75 lakh into 1 by 15 is equal to 5 lakh. For the second year 75 lakh into 2 by 15 is equal to 10 lakh. For the third year 75 lakh into 3 by 15 is equal to 15 lakh. For the year 4 75 lakh into 4 by 15 is equal to 20 lakh. For the fifth year 75 lakh into 5 by 15 is equal to 25 lakh. Note, depreciation is calculated on the depreciable amount, that is cost minus residual value. 3.10 Machine hour method. In this method, depreciation is computed based on the number of machine hours rather than years. Where it is practicable to keep a record of the actual running hours of each machine, depreciation may be calculated on the basis of hours that the concerned machinery worked for. Under machine hour rate method of calculating depreciation, the life of a machine is not estimated in years but in hours. Thus, depreciation is calculated after estimating the number of hours that machine would work during its whole life. Depreciation is equal to depreciable amount into number of machine hours during the year upon total machine hours during the entire useful life. Example, X Limited purchased a machine costing rupees 22 lakh having a scrap value of rupees 1,30,000. The machine has a useful life of 20,700 machine hours distributed as under. Year 1 to 3, 2,500 machine hours each. Year 4 to year 6, 200 machine hours each, and year 5 to year 10, 1,800 machine hours each. In this case, depreciation amounts will be computed as under. Depreciation amount is equal to 22 lakh minus 1,30,000 is equal to 20,70,000. Depreciation per hour is equal to 20,70,000 divided by 20,700 is equal to 100 rupees per hour. So we will calculate the depreciation amount for each year with the help of the following table. In the first column we will take year, in the second column we will take machine hours, in the third column we will take depreciation amount. For year 1, 2 and 3, machine hours are 2500 each. So depreciation amount will be 2500 into 100, that is 2,50,000 rupees each. For year 4, 5 and 6, machine hours are 2000 each. So depreciation amount will be 2000 into 100, that is 2 lakh rupees each. For the year 7, 8 and 9 and 10, we have machine hours as 1800. Depreciation amount will be 1800 into 100, that is 1,80,000 rupees each. 3.11 Production Units Method. In this method, depreciation is computed based on the production or output quantity. Depreciation is equal to depreciation amount into production quantity for current year divided by total estimated production quantity from the machine. Example: X Limited purchased a machine costing rupees 25 lakh having a scrap value of rupees 5 lakh. The machine is expected to produce 10 lakh units of output in the following manner. For year 1 and 2, 1,15,000 units each. For year 3 to 7, 1 lakh units each. And for year 8 to 10, 90,000 units each. Depreciation will be calculated as follows. Depreciable amount is equal to 25 lakh minus 5 lakh is equal to 20 lakh. Depreciation per unit is equal to 20 lakh divided by 10 lakh is equal to rupees 2 per unit. Now we will calculate the depreciation amount for each year through the following table. In the first column we have year, in the second column we have units of output, in the third column we have depreciation amount. For year 1 and 2 we have units of output 1,15,000. Depreciation amount will be 1,15,000 into 2, that is 3,30,000. For year 3 to 7 we have units of output as 1 lakh. Depreciation amount will be 1 lakh into 2, that is 2 lakh. For year 8, 9 and 10 we have units of output as 90,000. Depreciation amount will be 90,000 into 2, that is 1,80,000 for each year. 3.12 Depletion Method. Depletion means reduction or exhaustion. This method is used in the case of mines, quarries, oil well, etc. containing only a certain estimated quantity of resources or products. Depreciation is equal to depreciable amount into quantity of mineral or oil extracted during the current year divided by total estimated quantity from the mine, quarry or well. Example: X Limited took a quarry on lease by paying rupees 75 lakh rupees. As per the technical estimate, the total quantity of mineral deposit is rupees 1 lakh tons. The extraction pattern is given below. Year 1, 6,000 tons. Year 2 to 5, 5,000 tons each. And year 6 to 7, 17,000 tons each. Depreciation will be calculated as follows. Depreciation amount is equal to 75 lakh rupees. Depreciation per ton is equal to 75 lakh rupees divided by 1 lakh is equal to 75 rupees per ton. We will calculate the depreciation amount for each year through the following table. In the first column we take year, in the second column we take mineral deposit in tons, in the third column we have depreciation amount. For the first year, mineral deposits in tons is 6,000. Depreciation amount will be 6,000 into 75, that is 4,50,000 rupees. For the year 2 to 5, we have mineral deposit in tons 15,000. Depreciation amount will be 15,000 into 75, that is 11,25,000. For the year 6 and 7, we have mineral deposits in tons 17,000. Depreciation amount will be 17,000 into 75, that is 12,75,000 rupees. 3.13 Accounting entries for depreciation. Depreciation can be recorded in books of account under two approaches which are described below. Method 1, asset credit method. Journal entry will be depreciation account debit to fixed asset account and profit and loss account debit to depreciation account. Under method 2, provision for depreciation method, depreciation account debit to provision for depreciation account, profit and loss account debit to depreciation account. Provision for depreciation account. There is no provision for depreciation account at all in asset credit method. In provision for depreciation method, depreciation for each year is credited to provision for depreciation account, which shows the accumulated depreciation on the asset. Effect on asset account. Under asset credit method, asset account is shown at historical cost less depreciation, so balance in asset account is reduced year after year. Under provision for depreciation method, asset is shown in the books at original cost. Net book value is equal to original cost less accumulated depreciation thereon. Note, the above schemes are applicable to SLM and WDV method. The same treatment is applicable under sum of digits, machine hours, production units and depletion methods. 3.14 Change in cost and residual value or life of asset. Change in historical cost. The historical cost of a depreciable asset may undergo subsequent changes arising as a result of increase or decrease in long-term liability on account of exchange rate fluctuations, price adjustments, change in duties, and other similar factors. When the historical cost of an asset has undergone a change due to the above circumstances, the depreciation on the revised unamortized depreciable amount is provided prospectively over the residual useful life of the asset. Change in estimated useful life and scrap value. The useful life and scrap values of major depreciable assets or classes of depreciable assets may be reviewed periodically. The change should be accounted for as a change in an accounting estimate. Where there is a revision of the estimated useful life or scrap value of an asset, the unamortized depreciable amount should be charged over the revised estimate. Example, B Limited owns an asset with an original cost of rupees 2 lakh. On acquisition, management determined that the useful life was 10 years and residual value would be rupees 20,000. The asset is now 8 years old, and during this time there have been no revisions to the assessed residual value. At the end of year 8, management has reviewed the useful life and residual value and has determined that the useful life can be extended to 12 years in view of maintenance program adopted by the company. As a result, the residual value will reduce to rupees 10,000. How would the above changes in the estimates be made by B Limited? Solution. The changes in the estimate would be effected in the following manner. The asset has a carrying amount of rupees 56,000 at the end of year 8, that is rupees 2 lakh minus rupees 1,44,000, that is accumulated depreciation. Accumulated depreciation is calculated as below. Depreciable amount or cost less residual value is equal to rupees 2 lakh minus rupees 20,000 is equal to rupees 1,80,000. Annual depreciation is equal to depreciable amount divided by useful life is equal to 1,80,000 divided by 10 is equal to 18,000. Accumulated depreciation is equal to 18,000 into number of years is equal to 1,44,000. Revision of the useful life to 12 years results in a remaining useful life of rupees 4 years. The revised depreciable amount is rupees 46,000, that is 56,000 minus 10,000. Thus, depreciation should be charged in future at rupees 11,500 per annum, that is rupees 46,000 divided by 4 years. 3.15 Change in method of depreciation. The depreciation method applied to an asset should be reviewed at least at each financial year end, and if there has been a significant change in the expected pattern of consumption of the future economic benefits embodied in the asset should be changed to reflect the change pattern. Whenever any change in depreciation method is made, such change in method is treated as change in accounting estimate as per accounting standards. Change in method of depreciation is applied with prospective effect. Hence, depreciation is recalculated in accordance with new method from the date method is changed. 3.16 Revaluation of depreciable assets. First revaluation upward, use revaluation surplus. On second revaluation or subsequent revaluation downward, use profit and loss account. Example, a plant and machinery costing rupees 10 lakh is depreciated on straight line assuming 10 years working life and zero residual value for 4 years. At the end of 4th year, the machinery was revalued upwards by rupees 40,000. The remaining useful life was reassessed at 8 years. Calculate depreciation for the 5th year. Solution. Depreciable amount cost less residual value is equal to rupees 10 lakh minus nil is equal to 10 lakh rupees. Annual depreciation is equal to depreciable amount divided by useful life is equal to 10 lakh divided by 10 is equal to 1 lakh rupees. Accumulated depreciation is equal to 1 lakh into number of years is equal to 4 lakh rupees. Carrying amount at the end of year 4 is equal to 6 lakh rupees, that is 10 lakh rupees minus 4 lakh rupees. Revised carrying amount after revaluation is equal to 6 lakh plus 40,000 is equal to 6 lakh 40,000. Now remaining useful life is 8 years. The revised depreciable amount is rupees 6 lakh 40,000. Thus the depreciation for 5th year is equal to rupees 80,000 that is 6,40,000 divided by 8 years. 3.17 Cessation of depreciation. Depreciation ceases to be charged when assets residual value exceeds its carrying value. The residual value of an asset may increase to an amount equal to or greater than its carrying amount. If it does, depreciation charge of an asset is zero unless and until its residual value subsequently decreases to an amount below its carrying amount. At the earlier of the date that asset is retired from active use and is held for personal disposal, or the date that asset is derecognized. 3.18 Retirement. Asset is retired from active use and held for disposal. It is to be recorded in books at carrying amount or NRV, whichever is lower. Any expected loss is recognized immediately in the P&L statement. 3.19 Sale or disposal of depreciable assets. Sale or disposal of depreciable assets is accounted in the following manner. First, ascertain depreciation for the year up to the date of disposal and charge the same for that year. Second, determine the net book value or written down value of the asset, that is equal to historical cost less depreciation till date, including depreciation up to the date of disposal. Third, compare net book value of asset with its disposal value and ascertain profit or loss on disposal, and thereafter transfer the profit or loss on disposal to the profit and loss account. Example, the Messrs LG Transport purchased 10 trucks at rupees 45 lakh each on 1st April 2018. On October 1st, 2020, one of the trucks is involved in an accident and is completely destroyed, and rupees 27 lakh is received from the insurance in full settlement. On the same date, another truck is purchased by the company for the sum of rupees 50 lakh. The company writes off 20% on the original cost per annum. The company observes the calendar year as its financial year. You are required to prepare the motor truck account for the year ending 31st December 2021. Solution. Machinery account. Here it will be a tabular format. So on the left hand side we have debit, right hand side we have credit. We will mention the columns as date particular amount for both debit and credit side. So on 2020 1st January to balance BD 2 crore 92 lakh 50,000. On 1st October to P&L profit on settlement of truck 4 lakh 50, by bank 27 lakh, by depreciation on lost asset 6 lakh 75,000. On 1st October to bank 50 lakh, on 31st December by depreciation 83 lakh 50,000, on 31st December by balance CD 2 crore 29 lakh 75,000, that is 3 crore 47 lakh. In 2021 1st Jan to balance BD 2 crore 29 lakh 75,000, by depreciation on 31st December 91 lakh, by balance CD on 31st December 1 crore 38 lakh 75,000. We can refer the working note opening balance on 1st Jan 2020 original cost as on 1st April 2018 4 crore 50 lakh less depreciation for the year 2018 67 lakh 50,000 comes out to be 3 crore 82 lakh 50,000 less depreciation for 2019 90 lakh. The amount comes out to be 2 crore 92 lakh 50,000. To find out profit or loss on settlement of truck, original cost as on 1st April 2018 45 lakh less depreciation for 2018 6 lakh 75,000. The amount comes out to be 38 lakh 25,000 less depreciation for 2018 9 lakh, amount is 29 lakh 25,000 less depreciation for 2020 for 9 months 6 lakh 75,000, amount is 22 lakh 50,000 less amount received from insurance company 27 lakh, that is profit is 4 lakh 50,000. Example, a firm purchased an old machinery for rupees 37,000 on 1st Jan 2018 and spent rupees 3,000 on its overhauling. On 1st July 2019, another machine was purchased for rupees 10,000. On 1st July 2020, the machine which was purchased on 1st Jan 2018 was sold for rupees 28,000 and the same day a new machinery costing rupees 25,000 was purchased. On 1st July 2021, the machine which was purchased on 1st July 2019 was sold for rupees 2,000. Depreciation is charged at 10% per annum on straight line method. The firm changed the method and adopted diminishing balance method with effect from 1st Jan 2019 and the rate was increased to 15% per annum. The books are closed on 31st December every year. Prepare machinery account for 4 years from 1st January 2018. So we have in solution machinery account. On the debit side and credit side, we have the columns as date particulars amount, date particulars amount. So for the year 2018, on 1st Jan, we will have a debit as to bank 40,000 and on credit on 31st December 2018, we have buy depreciation account 4,000. On 31st December, we have buy balance CD 36,000. In the year 2019, we have 1st Jan, we have to balance BD 36,000. On 1st July, we have to bank 10,000. On 31st December, we have buy depreciation account 6,150. On 31st December, we have buy balance CD 39,850. In the year 2020, we have on 1st Jan to balance BD 39,850 and on 1st July we have to bank account 25,000. On 1st July on credit side we have buy bank 28,000, buy depreciation 2295, buy P&L account, that is loss on sale 305 rupees. On 31st December we have buy depreciation 3,263 rupees, buy balance CD 30,987. In the year 2021 we have a opening balance on debit side to balance brought down 30,987. On credit side we have buy bank 2,000, buy depreciation 590, buy profit and loss account, that is loss on sale 5272, and by depreciation we have 3469 on 31st December. We have a closing balance of 19,656. So this is the depreciation account. Now we will see the working note. Book value of machine through straight line method can be calculated as follows. So in the first column we have particulars, in the second column we have machinery 1, in the third column we have machinery 2, and in the fourth column we have machinery 3 details. So cost of machinery are 40,000, 10,000, 25,000 respectively, less depreciation for 2018, 4,000, written down value as on 31st December 2018, 36,000, less depreciation for 2019, 5,400, and on the second machine 750 for 6 months, written down value as on 31st December 2019 are 30,600 and 9,250 for machinery 1 and 2, less depreciation for 2020, 2,295 and 1,388 and 1,875 for machinery 1, 2 and 3 respectively. Written down value as on 1st July 2020 for machinery 1 is 28,305, less sale proceeds 28,000, loss on sale is 305 for machinery 1. Written down value as on 31st December 2020 for machinery 2 and 3 are 7,862 and 23,125 respectively. Depreciation for 6 months in 2021 is 590 for machinery 2. Written down value as on 1st July 2021 for machinery 2 is 7,272. Sale proceeds from machinery 2 is 2,000. Loss on sale of machinery 2 is 5,272. Depreciation for 2021 for machinery 3 is 3,469. Written down value as on 31st December 2021 for machinery 3 is 19,656. 3.20 Summary. Property, plant and equipment are tangible assets that are held for use in production or supply of goods or services or rental to others or for administrative purposes and are expected to be used for at least 12 months. Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. It is the reduction in the value of fixed tangible assets due to wear and tear and upgradation of technology and afflux of time. Objectives for providing depreciation. To calculate true cost of production of goods or services rendered which involve usage of fixed assets in their production. To correctly measure the income as per the matching concept. To depict true financial position by valuing the assets after deducting depreciation. To provide internal funds for replacement of fixed assets by charging depreciation from profit and loss. Factors influencing depreciation. Number 1, historical cost. Number 2, estimated useful life. Number 3, estimated residual value. Methods of depreciation are fixed installment or straight line method, reducing balance or written down value method, sum of digits of years method, machine hour method, production units method, depletion method, straight line method. An equal or constant amount of depreciation is written off from the depreciable asset every year. Written down value method, depreciation amount for each year is computed by applying a fixed percent on the opening balance of the asset. Sum of digit of years method, depreciation amount for each year is computed by applying the following formula. Depreciation is equal to depreciable amount into number of years of balance useful life including current year upon total of digits of the useful life of the asset in years. Machine hour method. Depreciation is computed based on the number of machine hours rather than years. Depreciation is equal to depreciation amount into number of machine hours during the year upon total machine hours during the entire useful life. Production units method. Depreciation is computed based on the production or output quantity. Depreciation is equal to depreciable amount into production quantity for the current year divided by total estimated production quantity from the machine. Depletion method. Depletion means reduction or exhaustion. This method is used in the case of mines, quarries, oil well, etc., containing only a certain estimated quantity of resources or products. Depreciation is equal to depreciable amount into quantity of mineral or oil extracted during the current year divided by total estimated quantity from the machine, quarry or well. Thanks for listening the lesson.